Members of the Senate Banking Committee continue to wrangle over details of financial reform. Does each passing day spell an end to reform hopes, or is a compromise possible? For more on this, we are here in Washington with Bob Pozen. He is the chairman of MFS Investment Management. As such, he oversees some 175, at least you have to oversee, let's put it that way, $175 billion. You're the former president of Fidelity Management and Research, the former vice chairman of Fidelity. A lot of experience in money management, and you understand what's at stake for Americans in the financial reform debate. Now, Bob, let's start with this, because we've been talking about Vikram Pandit's testimony before the TARP Oversight Panel today. The Citigroup CEO says, on the one hand, that banks should be banks. They should be focused on customers. In some ways, he's effectively endorsing the Volcker Rule, as it's called. And on the other hand, he says there should be a consumer financial protection agency, although he's not saying whether it should be independent or whether it should be in the Fed. I want to get your views on both of those issues. The Volcker Rule, is it the right thing to do? And secondly, where should that consumer agency be?
Well, I support the concept of risk reduction in banks, and they shouldn't be engaged in highly speculative activities. The problem first is one of definition. A bank can take a short position as part of a hedging strategy. It can do that as part of a market-making strategy, which produces liquidity. It can be helping a customer. So to have an outright ban against all proprietary trading through legislation seems to me not very workable. The House bill already includes a provision that gives regulators in specific situations, if banks are taking excessive risk, to require them to have more capital or to limit their activities. Given all the varieties here of trading and given all the complexities, that's a much better approach.
Well, but should we have confidence in regulators to be able to determine what the banks are actually doing and whether or not they do need to reserve more capital?
Well, I do think we should have confidence. The bank regulators have gotten a lot more sophisticated. But here, if we have an outright ban, all that activity is just going to move abroad. And it's not sensible, because we're trying to reduce risk and we're trying to increase liquidity. If banks are proprietary trading in a way that reduces risk or helps liquidity, why should we be stopping that?
Bob, another enormous issue of debate down here. What happens to the Consumer Financial Protection Authority? There was some talk that it wouldn't be created at all. The latest negotiations would have it go towards the Fed, and now even that is uncertain. What do you think should happen?
Well, I think we ought to divide it in two. We have lots of lending activities that are done by non-bank lenders, payday loans, check cashing, debt collection services, subprime loans. So these are done by non-bank lenders, and they're done primarily for low-income families. Nobody's really regulating them very well. So that ought to be the core of the new consumer agency. But the problem originally was that the jurisdiction was so broad that it included all deposits, all loans, all credit of all sorts, and much of that is already regulated by the banks. We're going to have a new national bank supervisor that's going to combine the Office of Thrift Supervision and the Comptroller of the Currency. So if we created a separate division that was a consumer protection division, that would hopefully satisfy the critics who say that those agencies are totally oriented toward safety and soundness.